Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Luke Tilley, chief economist at Wilmington Trust, to discuss a recession versus soft landing scenario and how investors should be positioned in this environment. Luke, it's great to see you as always. Welcome back to Trade Talks.
No, thanks for having me again, Jill.
You got it. And let's talk about the different probabilities on the recession scenarios. What do you see there?
Yeah, we put about 55% chance on a mild recession. So obviously that's our baseline expectation, and pretty mild recession later this year. We put 40% chance on a soft landing. That leaves a 5%, which we think is kind of a minimal chance of a severe recession. That would be kind of a surprise to us. But I think the keys are really that mild recession. We expect to be, in an economic sense, pretty mild in the sense of pretty small declines in consumer spending, pullbacks in capex, and of course the ongoing stress in the banking system right now is really weighing on the economy, Jill.
So what's the key to a recession versus a soft landing?
Yeah, well, we all know that the consumer is 2/3 of the economy. So if consumers keep spending, we're not really going to have a real recession. So what it comes down to is whether the job growth continues. And if you work backwards from there, if companies keep hiring and if they keep spending on capex, and we shouldn't really have a recession. So what we're watching really closely is the cumulative lagged impacts of all of the rate hikes from last year. We think that that has a much bigger bearing on whether we have a recession than whether the Fed goes another 25 or 50 or anything like that. It's really as those interest rate costs are passed through to the economy this year, and firms are making decisions about whether to hire and spend on capex is going to be the main determinant. And like I said, is if the regional bank situation causes some pullback in loans and that has those kind of impacts, that would be the biggest risk right now.
Do you think the Fed is going to hit its 2% inflation target, or is that a bit ambitious?
I think they'll hit it. The real question is whether they hit it, anytime soon, because the longer that inflation stays sticky to the upside, the more they're going to crank up rates. Because the one thing I am sure of is that they are determined to hit it. Whether it requires a recession or not to come down to it is a whole other question. So we know that goods prices are falling. We're near certain that shelter prices will flow through to slower shelter readings on the CPI. Those services prices are still high, and we expect those to come down. So we're expecting low to mid 2% readings by early next year to the middle of next year. But if those service prices stay high, then it's going to be much more challenging, and the Fed will have to get more aggressive.
Well, another challenge presenting the Fed, of course, is the strong employment data. Are you concerned about the labor market longer term?
We're concerned about longer-term labor market because we've had such a hit to the labor force. Now, the past 2 months have been really encouraging, more than 1 million people moving into the labor force over the past couple of months. And we do see a little bit of a return to normal. But over the longer term, there's been so much permanent retirement, and we took such a hit on immigration over the past couple of years that we do think that the labor market is going to remain tight, and that causes challenges for wages. That said, we are, as I said, encouraged about the past couple of months. Things really could be turning there.
So how would you recommend to investors to be positioned within this backdrop?
Yeah, in our sort of our flagship portfolio, which is a central risk, we are underweight to equities. Within the U.S., we prefer large cap over small cap, so that underweight goes to small cap equities, which of course are more highly levered to the business cycle, the market cycle, and a little bit more at risk from the regional bank situation. We're also underweight to international developed equities, of course, all the risks in Europe, and that leaves us with a little bit of an overweight to cash relative to benchmarks, a little bit of overweight to fixed income. And then I think the last thing is, in this higher rate environment, when we look specifically at equities, we're looking at higher quality companies. Strong balance sheets tend to do better in these kind of environments, Jill.
Yeah, and you also noted that investors have to watch broader financial conditions more carefully and, keeping a pulse on the real time, the real economy. Explain to us what you mean by that.
Yeah, it's so challenging because we do have really good measures. There's lots of indices that measure financial conditions, and we can watch those and watch all the components of those, whether it's credit spreads, interest rates. The real challenge is this regional bank situation and all of the stress in the banking environment. The decisions just at the banking level to sort of cut back on loan volume doesn't necessarily show up in that data very quickly. So we're doing everything we can to watch the daily indicators, the weekly loan balances, the movement towards the Fed and those loaning facilities, because it's really hard to see what the banks are going to be doing. But we do cite that as the biggest risk.
Right, because it does trickle down into the overall economy and, of course, the job market. If they're not lending, especially to smaller companies that do provide so much of the labor force and it allows them to grow, that trickle down effect could be pretty substantial.
Yeah, that's the real concern right now, right? Because businesses, small businesses, they still see strong orders. They're starting to hire a little bit more, but that trickle down effect would come from just the availability of credit, people deciding to cut back a little bit. And that's when you see economies go into a downturn, is when you have those ripple effects and trickling down and one thing hitting the other that we're concerned about. So it's a sort of a longer term look, but it's all going to come back to those financial conditions, Jill.
All right, Luke, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.